Hello everyone, welcome back. So in this video, let us discuss about option moneyness. So what exactly is moneyness? Well, it refers to the relationship between the strike price of an option and the current market price or the spot price of the underlying asset. So when you buy an option, the premium you pay to the seller depends on the strike price you choose. And this premium varies based on the moneyness of the option. So it can be classified into three categories: in the money, that is ITM, at the money ATM, and out of the money OTM. Let's break down each of these terms to understand them better. In the money options are generally more expensive. The deeper in the money you go, the higher the premium becomes. An option is considered in the money if exercising it would lead to a positive cash flow for the buyer. Call options are in the money when the strike price is lesser than the current market price or the spot price. On the other hand, put options are in the money when the strike price is higher than the spot price. See, suppose a stock is currently trading at rupees 100 in the market. If you buy a call option with a strike price of 80, you have the right to buy the stock at 80 even though it is currently worth rupees 100. So that's a great deal for you, right? And the deeper you go in the money, say with a strike price of 70 or 60, the premium increases even more due to increased risk for the seller. And out of the money options are the opposite of in the money options. A call option is out of the money if its strike price is higher than the spot price, while a put option is out of the money if the strike price is lower than the spot price. So, in case of OTM options, the situation favors the option seller, so they charge a lower premium. An option is at the money when the spot price of the underlying asset is equal to the strike price. Otherwise, the strike price that is closest to the spot price is called as the at the money strike. Now, to understand this better, let's look at an option chain for the Nifty 50 index. Suppose the current spot price of Nifty is 23,706 and the strike prices are available at the intervals of 50 points. The strike price that is closest to 23,706, that is 23,700, is the ATM strike, at the money strike, for both call and put options. So as you see in the option chain, the left side shows call option and the right side shows the details of put option. ITM strikes are highlighted in grey. So for call options, ITM strikes are those below the spot price, and for put options, the ITM strikes are those above the spot price. And if you look at the premium, you will notice they increase as options move deeper in the money and they decrease as options move further out of the money. Many retail traders often buy deep out of the money options, thinking their risk is limited to the premium paid and that the profits could be unlimited if the market moves in their favor. However, they don't always consider that the probability of success in such trades is not in their favor. So, this behavior is similar to buying a lottery ticket. You pay a small amount hoping for a big win, but the likelihood of winning is very, very low. So, for example, when the Nifty index is around 23,700, a deep OTM call option with 24,100 strike price is available for a premium of 7.8 rupees. So, if Nifty closes above 24,178.8 on the expiry date, the buyer of this call option would make unlimited profits. If it closes below 24,178.8, their loss would be limited to just 7.8. And this is what attracts them to buy deep out of the money options. So there's a popular analogy in the options market. Selling options is like running a casino, while buying options is like gambling at a casino. In the end, just like the house usually wins, the probability of success is mostly in favor of the option seller. So to put it simply, think of it this way. Call buyer is bullish, meaning they expect the stock or the index price to rise from its current level. So the strike prices that are yet to be reached, that is, those above the current spot price, are considered as out of the money strikes. Meanwhile, the strike prices that the spot has already surpassed are the in the money strikes. On the other hand, a put buyer expects a stock or an index price to decline. So the strike prices that are yet to be reached, that is, those below the current spot price, are out of the money strikes. While those that the spot price have already crossed are ITM, that is, in the money strikes. So remember that The concept of moneyness should not be confused with the actual profits or losses from holding an option contract. While moneyness indicates whether an option is in the money, at the money, or out of the money based on the underlying asset prices, it does not account for premium paid. Therefore, an ITM option holder may still face a loss if the premium paid exceeds the cash inflow from exercising the option. Suppose you bought a call option with a strike price of 90 on a stock that is currently trading at 100 in the market. This means your option is in the money because you have the right to buy the stock at 90, which is cheaper than the current market price of 100. However, let's say you paid a premium of 15 for this option. So if you exercise it, you can buy the stock for 90 and immediately sell it for 100 in the market, giving you a cash inflow of 10 rupees. But since you paid a premium of 15 rupees, your actual profit is negative. So the cash inflow from exercising the option is rupees 10. Premium paid is 15. So the net loss here would be 15 minus 10, which is 5 rupees. So even though your call option is in the money, you still end up with a loss of 5 rupees per share. So this is why your break-even point is calculated as the strike plus the premium paid. So in this example, the break-even point for call option would be 90 plus 15, which is 105. This means the call option buyer will only make a profit if the spot price at expiry is above 105 rupees. Now, let's consider a put option. Imagine you bought a put option with a strike price of 110 on the same stock that's currently trading at 100 rupees. So this option is also in the money because you have the right to sell the stock at 110, which is higher than the market price of 100. Assume you paid a premium of 20 rupees for this put option. So if you exercise it, you can sell the stock for 110, that is 10 rupees more than the current market price, resulting in a cash inflow of 10 per share. But since you paid a premium of 20, you will incur a loss of rupees 10. So your cash inflow from exercising the option is 10, but your premium paid is 20. So 20 minus 10 will give you a loss of 10. So even though your put option is in the money, you would still incur a loss of 10 rupees per share due to the high premium that you paid. Now let's talk about the break-even point for this put option. Remember, for a put option, the break-even point is calculated by subtracting the premium paid from the strike price. So in our example, the strike price is 110 rupees and the premium paid is 20 rupees. So the break-even point here would be strike price minus the premium paid, which is 110 minus 20, that is 90 rupees. This means that in order to break even, the stock price needs to fall below 90 by the time of expiry. So this is why it is important to understand that the moneyness does not guarantee a profit, as you also have to consider the premium you paid to acquire the option. Additionally, an option's moneyness can change over time due to fluctuations in the underlying asset price. An option that is in the money now could become out of the money later and vice versa. For instance, if the current spot price of the Nifty index is 23,706, then 23,700 strike price would be considered at the money for both call as well as put options. However, keep in mind that the spot price is not fixed and can fluctuate. So if the price drops to 23,656, the 23,700 strike price would now be the OTM for call option and ITM for put option. Meanwhile, the 23,650 strike price would become the new at the money level. So option holders usually won't exercise their contracts if they are out of the money, as it wouldn't be profitable. However, many traders buy OTM options because they're cheaper, hoping that the price will move in their favor, turning their OTM to ITM option by expiry. Thus, understanding option moneyness is crucial because it helps us decide which option to buy and whether it aligns with our market outlook. But always consider the premium paid to truly gauge the profitability. So that's all for this video. See you in the next one. Thank you.